Joining us now is Charmaine Mosavar-Rahmani, head of the Investment Strategy Group for the Consumer and Investment Management Division at Goldman Sachs. She's also Goldman's Chief Investment Officer for Wealth Management. Charmaine, I mean, not everyone does this, and there's always a possibility that we could have an adverse event in the markets that a lot of people never, ever even consider, and that always makes me nervous. So I like these probabilities. So we got 60% that the S&P gives us a decent return, 7 to 9%. What I was highlighting is there is an outside chance that you could see a 3,000 S&P minus 20, minus 19%, 15% odds that that happens. There's always got to be that, I would think. So it's good to admit the possibility. Welcome, by the way.
Thank you very much.
Is that your own style for just acknowledging that nobody really knows?
That's a very important point that you make, and we always put forth our views with probabilities. The reality is we're trying to convey to our clients that we can't have false precision and that it is all a matter of probabilities. Since the trough of the global financial crisis, we have had more upside probability than downside probability, but we also always want clients to know that there are risks out there, whether the risks today are a turn in infections and an increase, while most people think it's unlikely to have a fourth wave. There is some possibility that the New York strain, for example, does become dominant, and we're not sure what kind of impact it will have given vaccinations or natural immunity from infections. So we just want clients to think about the risks. We can have a deterioration, for example, in U.S.-China relations. So while our base case is about a 7 to 9% return, we also have a much higher probability to the upside. We have a 25% probability to the S&P getting to something like 4350. So there's a lot more upside. And again, since the global financial crisis, we've had much more upside. And that drives our recommendation to clients to stay invested and not be caught up in the volatility and the gyrations of the market on a short-term basis.
In terms of looking under the hood, you are a value. You would overweight value versus growth in small cap versus large cap. Is that still consistent with where you are today?
At the margin, we recommend clients always have what we call a valuation orientation. That doesn't mean liking value stocks versus growth stocks. It means if they want to invest in something, there has to be some real value attributed to that asset class. But in fact, specifically tactically right now, we have gone overweight value sectors. So, for example, we like the energy sector. So whether it's the energy sector in the S&P 500 or whether it's master limited partnerships, we do like an overweight to that sector, and it's been a great return so far. We like Eurozone banks, for example. We think they were incredibly distressed, so we have a tactical allocation to that sector, so looking at financials, which again would point towards a value orientation, given how cheap value is relative to growth stocks.
Shepard Smith here. Thanks for watching CNBC on YouTube.